This is the part we talk about financial planning. We talk with our financial planner, CFP Harrison Johnson. And today we're talking about why converting all of your pre-tax retirement account to a Roth might be a big mistake. And that is something that I've seen people, they just don't do. They just, like we're just talking about people buying houses, all these crazy things people do. They need a good financial planner. Harrison, why should they not be doing this?
Well, everyone likes the idea of tax-free retirement income. A lot of people like the ideas of Roth accounts or Roth conversions, but it's important to remember when you're putting money into a Roth account, specifically from a pre-tax account, there is a cost to it. And whenever you convert money from a tax-deferred account like a traditional IRA or 401k or whatever it is into a Roth, the amount that you move over is income, and it's taxed at ordinary income rates. Now, that's not necessarily a bad thing, but in the sense of, trying to move over 100% of your money, what that means is to move it over, you're going to pay taxes on it. And then if you have no pre-tax money left after that, you're probably going to be in a much lower tax bracket, especially if your remaining retirement income is Social Security or a little bit of pension income. So in other words, you might get to a point where you have really no tax liability at all, which means you paid taxes to convert money just to be at a point where you were in a 0% tax bracket. It's much more efficient to try and keep your taxable income consistently low through withdrawals or conversions or whatever it is, and that's how you're going to increase your after-tax retirement income.
Before you came with us many years ago, I would look at people doing that, and I would look at the break-even point.
Mm-hmm.
Like, okay, so you're going to pay these taxes. When does it break even for you? Do you do that for people, saying, okay, this is why you can't do too much, you should only do this amount? How do you come up with a formula of what they should do?
That's part of it. The part to keep in mind is when you have money in a traditional IRA or a 401k or any pre-tax account, the thing to keep in mind is the amount of money in there is deferred income. It will be taxed. It's just a matter of when. When you are contributing to one of those accounts, you're not really getting a tax deduction. What you're doing is you're deferring your income to be taxed at some point in the future. So that's the way to think about it. You have this deferred income in this pre-tax account. It is your choice when to withdraw that and when to pay taxes on it. Now, keep in mind, when you get into your mid-70s, you have to take your required distributions, which all of those distributions from those pre-tax accounts are taxable. They can push you into higher tax brackets. They can trigger IRMA. They can cause problems like that. So there is going to be income from those accounts. And so when we look at doing conversions, it's what is the tax rate now that we can do that conversion at versus if we do not do the conversion, what tax rate will you be at later on in retirement or in your 70s or 80s or 90s? And if we don't do the conversions now, if the remaining required distributions will push you into a higher tax bracket, then it likely makes sense to do the conversion. So for a lot of people, that might be, at the start of retirement in their 60s, they do conversions all the way through their mid-70s. If you can convert at a 12% rate, for example, now, and then avoid a 22, 24, 25, 32% tax bracket in the future, then it's going to make sense. You're winning on the delta. But by doing 100% of all the money over, you don't want to pay 22%, 24% now to get to a 0% tax bracket in the future. It'd be much more efficient to try and stay, for example, consistently in the 12% bracket all the way throughout your retirement.
Yeah, I know it's something that people just kind of do willy-nilly, and it's like, I kind of going back to what you initially said, is like, it doesn't sound bad, right? You get to a point where there's no tax liability, but I mean, the big thing that I think is so important for people to understand is the fact that, as you said, why would you pay tax at 12% to then maybe pay tax at 0% 5 years from now? That makes no sense at all. The math on that, I know the kids nowadays say the math's not math, And I can say that now. I'm older, I guess. The kids nowadays.
That's right. The youngins. Yeah. Again, it comes down to, the way that tax brackets work is the first chunk of income is taxed at one rate. When your income goes above that, it's taxed a little bit higher. So of your total taxable income, it's taxed in chunks. So ultimately, if you can keep your income in consistently the lowest tax brackets, that's how you're going to have a higher level of taxable income. And another thing to kind of compare it to is it's almost like paying down a low interest rate mortgage. So for example, there's a lot of people that out there that were able to refinance when rates were low. Maybe you've got a 30-year mortgage at 3%, well, you could pay it down really quickly if you wanted to. And what's that going to do? It's going to reduce your lifetime interest on that loan. But what is the cost of doing that? You're taking assets or resources from some other account or some other source that maybe that money would be better left there if it's earning more than 3% just to save on the interest. So the same thing with Roth conversions. People like, getting to the point of tax-free income, but they're not looking at, well, what is the cost? What are the resources that you're using now and at what tax rate to get to that point? That's why for every person, there is an efficient path to go through that, and it comes out to trying to keep things consistently low over time.
Well, Harrison, this is why people need a good fee-based financial planner, not a commission financial planner, a good fee-based financial planner that gets paid a fee off of doing the right things opposed to selling products. So thank you very much for being here today, and great information as usual on being careful how much to convert to the tax-free Roth IRA.
Absolutely. Thanks, guys.
All right, you're welcome.